How to stop losing money in stocks? Because losing money in stocks sucks, and all of us have done it. But what if I told you that losing money is optional? If you don't have all three pillars, you're choosing to lose money. I'll cover how my client lost 99% of his investment, and hint, he was missing all three pillars. Then I'll show you the 5-step framework that I learned from Warren Buffett that I use to save me from losing money. And last, I'll show you how I apply that framework against the client's investment. Will I make the same mistakes, or does Warren Buffett's framework work? You'll see. In May 2025, I started working with a client and asked him if he'd had any losses in the stock market. And he was happy to share this one in particular so that we could share that with other people that they could then learn from as well. It was on the requirement that as long as he remained anonymous. So for this, we'll call him Boris. In keeping this as accurate as possible, I'm going to read out what we've agreed on for the story. So go with me, please. So back in 2007, Boris was just starting his investing journey. 18 months prior, they had invested in a stock on the back of a mate's stock tip. It happened to double in that 18 months. Nice. So Boris felt pretty confident he knew what he was doing. He was on the lookout for another investment idea, one that would do the same, get rich quick. Flicking through a finance magazine, he found it. The story was compelling. It was a novel device. It was in biomed industry and had an increasing ideal customer worldwide, and it had significant hype around that opportunity. So Boris checked the stock price and saw it was going up. He invested $3,000, which was about 20% of his portfolio at the time. So what happened? Well, the stock price had peaked and it was bouncing around for the next year. At which point, the company sent a notice around that they were going to sell more shares to raise some capital. Boris shelled out more money and bought some extra shares. What happened after that? The stock price declined, and for the next 18 years, it has been almost worthless. Let us know in the comments if you've been burnt by a stock like this. Now, Boris never sold the stock, so he still owns it, but the shares are worth fractions of a cent. Boris told me he learned that he shouldn't pick stocks and he should just buy ETFs. Now, this is the kicker though. Boris learned the wrong lesson. Now, I found there are 3 pillars of successful investing, and without one of them, this is what happens. But Boris's results here come from not having all 3 of them. And if you want higher performance than ETFs, you need them. So the 3 pillars of successful investing are a proven strategy, or knowing the right things. 2, it's competence, know how to do those right things. And then 3 is rational action. So you need to know how to do the right things when it counts. Just like an archer, you need to know the right things. Like you need to know the knowledge of how to hold the arrow, the bow, the string, the angles, the distances that each set of arrows, bows, etc. can cover. Then you need to know how to actually do it. So you need to practice those skills until it's second nature to be able to perform. And then you need to know how to do it when it counts. So you need to simulate these challenging environments, like a battlefield, for instance. And if the guy's running at you with a sword, what are you going to do? If you haven't practiced under that scenario, you're going to get dead. So let's apply this framework to Boris's investment. Proven strategy, so the knowledge. So there was no real strategy. He just had a get rich quick. And he spent about 5 minutes considering a $3,000 investment. And that represented 20% of his portfolio at the time. So they had no framework for what's a good investment or a bad investment, or the things to look for in a business. 2, competence. So knowing how to do the right things. So he lacked the skills to understand the business properly. He relied entirely on a magazine's article and the hype rather than actually thinking for himself. And 3, rational action. So knowing how to do things, the right things, when it counts. So every decision that Boris made was driven by emotion. There was nothing rational about it. He had fear of missing out, or FOMO, and that drove him to make that intuitive, quick decision to jump on it. And then a year later, he decided to buy more. And he wasn't thinking about it and didn't decide to check how the business was going. And he had hope in those years to come when the stock price had gone down drastically that the stock price might bounce back. And he kept holding on to that hope. This is exactly how not to invest. Losing the money didn't just cost him his original investment. It cost him the opportunity cost. So in this table, I've broken down his original investment against the option if he had done nothing. So in October 2007, he made his original investment of $3,000. Looking at it in May 2025, it was worth about $5. Looking at if he'd just done nothing and kept on to the cash, his $3,000 from 2007, well, he'd still have $3,000 in 2025. However, it would be worth less because of inflation, but he'd still have his $3,000. Now, most investors actually do worse than if they had just bought an index fund and completely forgot about their investments in it because of market crashes and things like that. When investors start to get emotional, sell, buy, do all sorts of crazy stuff. In this graphic from Bernstein, we look through a 20-year period from 1993 through to 2013. And over here, it's a little bit in red, we can see the average investor. And they made less than 3% return. And during the same period, the S&P 500 made a little over 9% return. BlackRock, over a similar period from 1992 to 2011, and look at their average investors, and they got a similar result as well. That was through two significant stock market crashes with the dot-com crash and the 2008 global financial crisis, which was the second worst recession since the Great Depression. So what's Warren Buffett's recommendation to the average investor? Warren Buffett has many quotes on this, and so he speaks in his Berkshire Hathaway 1993 shareholder letter. He says, by periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. And he said something similar in 2008. A know-nothing investor will get decent results as long as they know they're a know-nothing investor. Diversify as to the time they purchase their equities and as to the equities they purchase. So all he's saying there is don't try and fool yourself. And what you should be doing is just dollar cost averaging into a diversified index fund. So then our opportunity cost moves up to if our investor was able to notice he was a know-nothing investor. That brings our baseline back to, say, the S&P 500, and we can see that we would have made our $3,000 would have turned into $16,000 by May 2025. Now, that means that our investor, so with no three pillars, has pretty much just blown 16K as his opportunity cost. And if he'd done nothing with it and just kept it in the bank, that's 13 grand he's lost over that period. Warren Buffett also talks about know something investors. So it's actually a continuation of the rest of that 1993 quote. So on the other hand, if you are a know something investor, able to understand business economics, and to find 5 to 10 sensibly priced companies that possess important long-term competitive advantages, conventional diversification makes no sense for you. Similarly, with his 2008 quote, it continues. That's crazy for somebody that really knows what they're doing. And you will find opportunities that if you put 20% of your net worth in it, you'll have wasted the opportunity of a lifetime, in terms of not really loading up. So what he's saying there is really talking about when opportunity comes knocking, be ready and be ready to load up. If you invest in yourself and build your 3 pillars, this is what the opportunity cost is. For people like us, our average is just dollar cost averaging into an index fund. That being the know nothing investor approach, and that is our new zero, so no opportunity cost. Now, anything above that is what the opportunity cost is. So we can see that if we'd had the 3 pillars, Berkshire Hathaway's stock would come up on our radar and it went to $22,000. And that gives us an opportunity cost of $6,000, which is just the difference between if we'd invested in the S&P versus Berkshire. Or if we'd been able to find Monster Energy at that time in October 2007 to May 2025, it'd be worth $43,000. with an opportunity cost of 27 grand. If we'd been able to find Amazon during that time, $3,000 is now worth $136,000, which is an opportunity cost lost of $120,000. So if you think picking Amazon or Monster Energy back in 2007 is ridiculous, wait till the end because it is not ridiculous. There are investors that have absolutely been able to pick these exceptional businesses back then and earlier. Now onto the 5-step framework. In 2019, I had no idea how to invest in stocks. And I was making good money in my job, but I had no idea how to make or build real wealth. I grew up believing that stocks was like gambling, that the system was rigged and that there's no point in trying to pick stocks. But I couldn't accept being average when I knew I had potential. So I took action. I found successful investors like Warren Buffett, Seth Klarman, Howard Marks, and others. During those late nights researching Warren Buffett's successes, I started to see the puzzle pieces all fitting into place. And I was able to grab out the 5 core areas that he was focusing his attention on. It also aligned with other successful investors that I was looking at the time. By avoiding the losers, we're only left with the winners at the end of the day. I use this framework to identify the red flags, so what are businesses to avoid and what specific things to look out for. Then I also use it to find the green flags, so the good things we want to find in businesses for the winners. I call it the 5M framework. 5M framework is mastery, moat, management, margin, maintain. So those 5 M's are really what answers these big 5 questions. So can I tell what will happen to it in the future? Is it a great business? Can I trust the people who run it? Can I buy it when it's cheap? Is it better than what I already have? But we use the 5 M's to make sure it's a bit more memorable. First one, mastery. So have I mastered an understanding of the business? And has the business mastered its customer? So the big things we want to see here is competence. So do I understand the business? Is it in my circle of competence? It's consistency. Is the business consistent? If it's ups and downs, we can't do much with it. And continuity. Is the business continuing relatively unchanged? If it's introducing new stock lines and things like that, or changing the business entirely, that's not continuity. Moat. Does the business have an enduring moat? So Warren Buffett refers the moat of the business is its strong competitive advantage. Is it able to repel and keep back other competitors or people that want to take the business? So moat, what is the business's moat? It's a durable competitive advantage that is difficult for competitors to overcome. We need to see evidence of it. We want to see how the adversaries or the competitors will go against it. And can we test? How does the business perform against different stress tests? Management. Can I trust management? So look at this is in 3 different areas. Candid. Is management candid? Aligned. Is management aligned with shareholders? And rational. Is management rational in how they're allocating the capital and the resources of the business? Margin. Can I invest with a margin of safety? So we're looking at value. So what is the value of the business? And can we buy for less? Can we buy this business for less than what it's worth? Maintain, which is one of the forgotten arts, is really just holding the bar. So is this investment maintaining or raising my standards? This comes down to discipline. So can I commit to this business for a minimum of 5 years? The answer is no, it's not a good fit. Exceptional, do I have the confidence of the business performance and my own courage to give this investment a minimum of 10% of the portfolio? Now, if you don't have that kind of confidence around specific pick, then it's best to look elsewhere or to do more homework and see if it is. And hone. Will this business provide a higher risk-adjusted return than what you currently have in your portfolio? You always want to be either raising the bar or waiting until those opportunities come around. If you want a copy of this or you want to learn more about the 5M's framework or how to do it for yourself, actually in the link in the description, it's free and it's my gift for you guys. Now let's apply that framework on the business that tricked Boris. Now I actually took Boris through this back in May. And one, he couldn't believe that I was actually able to find the original annual report from back in 2007, the one that would have been available at the time just before he purchased the stock originally. And two, he immediately understood the errors that he'd made. So it was night and day. So when I originally did this, it took me 20 seconds to find the latest annual report just by jumping into Google and typing it in. But to find the original report from 2007, it took a little bit longer. The business has had many name changes over the years, which is a little bit of a red flag in itself. So once I had that 2007 report, it only took me about 10 minutes and a quick skim of that annual report to make a decision. So let's go through it. So with the annual report for 2007, I'm going to go scroll through, have a look at the contents page, and specifically for Mastery. So I don't know enough about medical device businesses. It's outside of my circle of competence, but we'll chalk that up. I still want to check, has the business mastered its customer? So I want to have a look through the financial statements. So I want to check out the income statement and have a look if the business is making some money. So on the income statement for that year, I can see that they've amalgamated with another business. And so that's why they've got a parent entity and the consolidated entity. Now, revenue, which is just the money or the top line of the business, the money that they made last year was $185,000. They've then spent $1.2 million on consulting, employee, and director expenses. They've got an impairment expense, which could be anything. We've got research and development expenses of $1.3 million. Profit before income tax of a negative number. They've spent $5 million when from the money that they've made from the core product of the business is $185,000. So that's a problem. That's a big problem. This business does not make any money. It spends it and burns through it. So the business hasn't mastered its customer. Otherwise, it would be making a lot of money. So what about the moat though? This is still something we can check. From what we can see here, there is no moat. There is no competitive advantage that this business has against its competitors because it hasn't shown it. Don't believe a narrative from management. Believe their previous results, which you should be able to see in the annual report in the financial statements. And speaking of management, how can I tell if I can trust management? So I want to see what kind of incentives they have to make sure they're actually aligned with long-term shareholders. In the annual report, we want to be looking for things like a remuneration report or incentives. Those kind of words, we can just do a Control F and search for those to make it a bit quicker. So we can see here the different chairmans, executive directors. It's got a remuneration policy, and we want to just make our way down. You can see they've got short-term employment benefits, just cash, salaries, and fees. And then we've got here share-based payments. You can see that in the last year that they've given out almost $290,000 to Peter Marks, $114,000, $117,000, and $152,000 worth of shares out to various directors of the business. Now it comes back down, it's got this little one here. What is that from? So during the year, these guys received non-cash remuneration in the form of shares for successfully negotiating the acquisitions of Pulmo Sonics and Carmel Sonics in November of 2006. This equity was issued as part of the sale of shares agreement and consisted of ordinary shares and class shares, which have been converted to ordinary shares during the year on the achievement of milestones. None of those milestones, and only within 1 year, is very short term. The business hasn't produced any results from that purchase or the acquisition that has led to any extra value in terms of long-term shareholders. So I had a look through the cash flow statement and things did get worse. After having a look at the cash flow statement, I was able to have a more complete picture of what was actually getting spent and where. They made $186,000. They then spent $1.2 million on consulting, employee, and director expenses. They then spent $108,000 on travel and entertainment expenses, which sounds like a rort. They then spent $286,000 on capital raising. And then from that, they were able to raise $2.99 million. And that was used to fund the business until the end of the year. Then they had all that money that they had in those incentives that they gave to the directors of the business within 12 months of an acquisition with no long-term benefit to shareholders. They gave them $399,000 all up. Of that money that they've then, from the capital raising from other shareholders, they've then paid it out to the CEO and other directors within the business. As an immediate pat on the back, job well done, boys, that's really bad. They then ended the year with cash on hand of $588,000. So, what can we take from all this? Well, this business has zero long-term shareholder alignment and is a huge red flag. So, I can trust management that they will continue to line their pockets and profit for themselves. Plus, how are they going to pay, the $1 million in consulting employees and director expenses and all the other expenses they had when they've only got $588K left in the bank? And the business only made like less than 200,000. There's a big hole there that they've got to try and fill. Well, you guessed it, they're going to raise more capital. Every time they raise capital, they create more shares, which makes every other share that's already in the business own a smaller and smaller amount of the same business. Now, if a company was worth $1,000 and they had 100 shares, each share would be $10 worth of the business. Now, for our example, say if that company raised capital and it sold another 100 shares, when they spent that money that they got from the capital and it did nothing to add any value to the business, like we had here, it would still be worth $1,000. But there'd be 200 shares. So now each share is actually only worth $5 of the business. And so now if you've owned one share of the business, your $10 has now gone to $5. So the value of the business that you own is getting smaller and smaller and smaller. This is called dilution. Even if I had a good understanding of the business itself hasn't mastered its customer because there are no customers. There's no mastery. There's no foreseeable future for the business. There's no moat. There's no good future from that. Terrible management means there's going to be a terrible future. There's no need to check margin or maintain because we've already got to those three things. And that's our first pass of the business done. There's no need to waste more resources, your effort, your time looking into the business any further, and definitely no reason to go and waste your money on it. So why is the mastery, moat, and management sections and those core areas that Warren Buffett brought up such a good indicator of future performance? Actions speak louder than words. And so you can always check those kind of results through the actions of the business and having a look through their annual report. So where is the business now? Let's have a look. Well, from their 2025 annual report, we can see that there's been a big jump in their operating revenue from 2024 to 2025, almost $2.5 million, which is pretty good. The expenses of the business, though, are huge. So $8.8 million in consulting, employee, and director fees, share-based payment, the directors of the business, travel expenses have continued to make a loss. 2024, $7 million. And in 2025, $10 million loss as well. Doesn't get any better here with the balance sheet showing that all up, how's business gone in terms of its losses when they're accumulating? Where does it all go? They have accumulated losses of $150 million. And having a look at the shares issued, so in 2007, they had 7 million, or a little over 7 million shares. Right now, they have a little over 22,000. So the shares have tripled. So that means for every $1 that you'd invested in 2007, if the share price remained fixed, just from dilution, that $1 would be worth 33 cents. And that's just the loss from dilution alone. We can see here, it's cost them this year $500,000 to raise capital. And they've issued this year almost 10 million shares, total costs for those, and where that money's gone in the business. But from the $3 million that they made in revenue, what actually came out in cash to the business? So from its operating activities, receipts from customers, well, that doesn't look like $3 million. That brings out its actual operating activities, which is the main part of the business that should be making money, is actually used $9 million. from investing activities, it's made $1 million. And from the proceeds from issues of securities, they've been able to cover most of that $9 million by raising, yet again, more money from other investors over the last couple of years to the tune of $8.8 million in 2024 and $7.7 million in 2025. Now, these guys haven't gone bankrupt because they don't have loans with banks, and they just continue to issue more shares, raise capital from other investors, and repeat year over year and continue to add to those accumulating losses. So if ever there was an example of how to literally burn business value and destroy shareholder money, this is it, and without going bankrupt. Now, I feel sorry for the silly investors that keep buying this stock or keep getting convinced by the stock's promoters year after year. Now, they might be coming around with a story or a new narrative for the business or changing the business name every few years to give the appearance of something new or update the branding on it. But at the end, it's the same result. Now, here's a couple of quotes from Warren Buffett. In Warren Buffett's 1987 Berkshire Hathaway shareholder letter, he states, "Indeed, if you aren't certain that you understand and can value your business far better than Mr. Market, you don't belong in the game. As they say in poker, if you've been in the game 30 minutes and you don't know who the patsy is, you're the patsy." Savage, Buffett. Absolutely savage. And it's really relevant here. Because at the end of the day, these guys that keep buying it, who do you think they are? He goes on, in Warren Buffett's interview in 2019, "By far the best investment you can make is in yourself." And he continues, "If you invest in yourself, nobody can take it away from you. Don't be the patsy." I've spent over 2,000 hours learning these frameworks, applying them in the real world, and showing other investors how to do the same. This is the resource I wish I had when I was first starting out. I'm sharing it with you to save you time, effort, and your cold hard cash. Click the link in the description. It's free. It's my gift to you. Now that you know what a loser looks like, here's how to spot a winner. Monster Energy, the greatest stock of all time, and how a college dropout turned reclusive hedge fund manager was able to find it before Wall Street even noticed it. Watch this next video to find out how to spot a winner.